Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. Donald Trump tones down his rhetoric on Iran despite promising to levy more sanctions. Says America is open to a new deal with the country which will let it prosper. Bharti Airtel launches QIP to raise 14,400 crore rupees. The telecom operator is also looking to raise $1 billion via foreign currency convertible bonds with a green shoe option of another $250 million. State Bank of India launches a new scheme which looks to provide guarantee to home buyers for any delay in project completion. Carlos Ghosn goes on the offensive in his first press conference since fleeing from Japan, blames Nissan for his ordeal, accusing the Japanese car giant of trying to stop him from further integrating the company with Renault. Well, let's take a look at the trade setup for the day. There is green on the screen. There was green on the screen in yesterday's session in the US markets as well after Donald Trump's address, and the Dow and the S&P and the Nasdaq showed a very healthy uptick in trade yesterday. I use the term carefully, very healthy. It's not a very large move, but it's very healthy simply because of the uncertainty surrounding this. Not that the equity markets were pricing in too much of uncertainty even in trade yesterday, but because there was uncertainty and after that we were green on the screen, that should augur well for our markets in the session today. And in fact, it is rubbing off in some parts on the Asian screen as well. Mixed bag if you look at the Shanghai Tech, but Nikkei up about 1.85%. It was down almost 1.4% when it closed shut shop yesterday. So it's recovered all of those losses in percentage terms. In point terms, just about the losses recovered from yesterday. Hang Seng up about 1%, and the SGX Nifty shows an uptick of about 1%. And frankly, for an Indian market watcher, the most important thing which should bring a smile on the face of the bull is crude prices coming off after Donald Trump's announcement. There was a sharp pullback into crude prices across, and as a result of that, you should be, if you're an Indian trader today, your bets should be on the upside. Now, depends on how the stock or the index that you want to trade starts off, but ideally the bet should be on the upside simply because of this one chart, which is crude prices coming off. And therefore, because of this and the fact that the geopolitical stress seems to be easing off after comments from both the sides, not just Donald Trump's comments, but comments from both the sides over the last 24 hours, I reckon it will be back to business as usual for the Indian markets. And therefore, maybe, just maybe, mid-caps and small caps will return back to focus. Today, I think oil sensitives and steel companies also likely to be the key gainers in the session. So you watch out for mid-caps, you watch out for oil sensitives, and you watch out for the steel names. It's all about the globe, and that is what you should be focusing on. Now, I'll get to specific stocks in a bit, but since it's all about the globe, it's very important to get in a global perspective. Jeffrey Dennis, independent emerging markets commentator, joins us right now on the show. Jeff, good morning, and good evening to you, rather. Thanks so much for joining in. This is not entirely unexpected, but do you reckon that the fact that both the sides have sounded de-escalatory, if I can use that term, in their comments, would only augur well for the sentiment around markets?
Oh, yes, I think so. I think it's, compared to where we were 24 hours ago, I think it's quite a surprise, actually, that we've seen what we've seen in terms of a fairly modest Iranian response, clear evidence from the Iranian foreign minister that this is all they're going to do in terms of a response at the moment to the assassination of the general, and obviously a relatively, should we say, dovish set of comments from President Trump. So I think it's a big surprise, personally, although I'm not a political analyst, far from it. But at the end of the day, this is all good, I think, because the markets will be in a position, if they want to assume that this is it for the time being between U.S. and Iran in terms of any potential conflict, and we'll get back, as you've just said, to get back to business.
So what would getting back to business mean, Jeff, with an assumption that geopolitics is not top of the mind and crude prices have also seen a bit of a cool off? Would you reckon there is a better tilt for emerging markets to do more in the near term, depending on, of course, individual market functions as well? But would EMs have a better chance because of this cool off, or would you believe that DMs are a better bet right now?
I think it will be good for EM on a relative basis. I mean, my view has been all along that it's a fairly narrow path to emerging markets outperforming developed this year because, the big risk for emerging markets and their potential underperformance is if the global economy slows right down and you end up with a U.S. recession, in which case you'll get a stronger dollar, you'll get money coming back to the U.S., and typically EM underperforms in a recessionary environment. So clearly the spike in oil prices, given that it's not lasted for long at all, just a few days, I guess doesn't particularly change the outlook at the margin for the U.S. economy, but the window or the path, perhaps I should say, towards a EM outperformance is really in terms of soft U.S. growth without it being recessionary, the Fed being supportive, bond yields staying relatively low, and ultimately a weaker dollar, which I think is overvalued, which would then push money towards overseas. Now, today you've seen the dollar strengthening a little bit, but overall I think we may be back on that as a central case, with I think the big risk being still an outright U.S. recession. Whereas if, of course, the politics had got really bad and you saw really significant response by Iran and then retaliation again by the U.S., say the closure of the Straits of Hormuz, you could have seen oil prices go to $80, $90, $100 a barrel. And that would have been much, much more risky for the global economy and for financial markets and for EM. So this is a good resolution from what we know at the moment, and that narrow path towards some sort of EM outperformance, maybe back on track again now.
Just one final question, Jeff, on that, the very point, crude that you mentioned. What's your best case estimate? Would you believe that if things stand as they are, then the $70 per barrel mark that we had is a near-term top of sorts, and we may actually head lower after the kind of pullback that we've already seen in crude prices overnight?
I don't think we're going to head lower. I suspect where we are now is I mean, we may head marginally lower. I suspect the way you look at it now is we're back in the middle of the trading range. Let's call it $60 to $70 for Brent. And I think to go above $70 on a sustainable basis now, which obviously at the margin would be a negative for India because of all the oil imports that you have to do. I think that only happens now in the event the politics deteriorates once again. I think the global economy probably can't sustain oil prices on their own. The global economy cannot sustain oil prices above the $70 level. So the only way you go above 70 is either there's a massive or a significant cut in OPEC output, which seems unlikely at the moment beyond what's already been agreed, or you get a further escalation of political tension. So I'm inclined to think that oil prices are back in the trading range, perhaps towards the middle. There could be some testing of the downside in the short term. It depends what the economic numbers are going to be over the near term. And as ever, of course, it depends on what the dollar does. If you were to get a big sharp fall in the dollar moving forward from here on weaker U.S. growth, that could push the price of oil higher. But right now, it looks like the risk premium attached to oil because of the politics is being eliminated pretty quickly, and markets look reasonably well positioned. Oil's going to stay pretty stable, and obviously that's one less thing for the Indian market to worry about.
Yes, indeed, Jeff. Thanks so much for speaking to us this morning, and have a great evening and a good night to you.
Thank you very much. Thanks.
That's Jeffrey Dennis, an expert, veteran EM commentator, talking about, well, all the facets, really. We almost covered everything that we would want to know about this. De-escalation, so the outlook is simple. Let's wait and watch how it goes. Just very quickly, while we get to first word in a bit, just want to mention the few stocks that all of you should keep in mind in the session today. There are 4 or 5 names to which, to my mind, are the key focus stocks in the session today. But watch out for Kotak Bank. The promoter shareholding norms case is likely to be heard in the Bombay High Court today. Maybe we get a decision, maybe we don't. But that would keep Kotak Bank as a stock which will be firmly in focus today, very watched out for in the session today. Bharti Airtel and the move yesterday suggested that, but this is arguably a very important development. They've launched the 14,400 crore QIP. The indicative floor price is at a 435, which is a discount of about 5.2%. Most people that I spoke to believe that this discount, if at all the stock were to start lower, will quickly get bought into as well. It's about a 6.1% equity dilution, but it gives them the ammo to reduce debt, fund AQR and other AGR and other expenses. So this should be an important stock to monitor in the session today. That overhang on Bharti Airtel stock price was this QIP. Now that it is out of the way, it'll be an interesting stock to monitor in the session today. Up about 3% in trade yesterday, as I said. SBI and real estate stocks, all of them in focus because SBI has launched this new product, and when SBI launches something with regards to lending process or real estate, you would pay heed to that because it could well set the pace for what other companies or other banks do. The residential builder finance loans with buyer guarantee. Now, this may not be that big for SBI immediately, but it certainly sets the stage for more such products to come in, and therefore maybe the confidence of the buyer to come back to real estate will be very important to monitor what happens to some of the realty stocks in the session today, particularly Suntec Realty, because the MOU has been signed with Suntec Realty to finance 3 residential projects as well. Very interesting to see what happens to these companies in the session today. Lastly, we will watch out for the metal names. Some of the reaction played out in trade yesterday for the likes of NMDC, Coal India, Tata Steel, SAIL, etc. But this MMDR rules change would well have an impact on some of these. Watch out for the steel stocks in particular in the session today, though NMDC and Coal India won't rule out some more movement there. And last but not the least, just because of the expectations around Infosys about how the EBIT margin miss might weigh in on the stock, it played out on the stock in trade yesterday. The results come out tomorrow. We're very interested to see how the trades pan out on Infosys on this weekly options expiry day, as well as ahead of the results. The other IT stocks are doing fine. Infosys isn't. Today, IT might take a back seat. It'll be interesting to see what Infosys does too. However, let's tell you what's lined up on First Word today. Ida First Johnson to take us through the rupee's bittersweet ride over the last decade. Sajid then tells us why promoter pledges are here to stay at least in 2020. Agam lays out what's expected from IT firms in the third quarter. And Darshan then explains why Bajaj Auto's stock price performed better than Hero MotoCorp's in 2019. It's been quite a ride for the Indian rupee in the decade gone by, and depending on how you look at it, performance, you could be left with mixed feelings. Ira Duggal explains in this report.
We've just kicked off an entirely new decade. Yes, I know we're a few days late, but it's still early days, and there's much optimism about what lies ahead. But it doesn't hurt to keep an eye out on the rearview mirror. If you turn that rearview mirror around to the rupee, though, you will come away with, as we're saying, mixed emotions. The Indian currency actually didn't have a very good decade. So if you look at the Indian currency vis-a-vis its Asian peers, it was the worst performer actually in the decade. Over the 10-year period between 2010 and 2020, the rupee lost 52% against the US dollar. It started the decade of the 2010s at a 46 to the dollar kind of level, and it exited at about a 71 level. So during that period, you've taken out psychologically important levels like the 50s, the 60s, the 70s. You almost hit 75. You're just shy of that, and you closed the decade at about 71.5. Now, some of the comparative economies like Indonesia did a little bit better, lost 47% against the US dollar. The Malaysian ringgit was better off and lost under 20%. Well, the Chinese chart is there, but it's not really a comparable currency given the tight controls that the Chinese government maintains on its currency markets. Now, that's the glass half empty, but everything is relative. So if you change the countries that you're comparing the Indian rupee to, you come away with a very different perspective. So if you compare the Indian rupee to its BRICS peers, actually the Indian rupee performed the best out of the lot. So while we lost 52%, you had the Brazilian real, which weakened very, very steeply. The dollar gained 134% against the real. The dollar gained 107% against the Russian ruble. And of course, you had the South African rand, which depreciated 89% against the US dollar. So like I said, you change your lens and the Indian rupee doesn't look so bad after all. The 52% depreciation number looks large in its entirety, but this is over a 10-year period. So the average depreciation is not something that you should be particularly concerned about, especially given the fact that this decade was a period where we did have high and volatile inflation, at least for parts of it. So the inflation differential story was against the Indian currency. Now, we're not going to go back and tell you everything that happened over the last 10 years, but we will point out a few notable moments. Well, we had the 2013 taper tantrum, which reminded us that we had vulnerabilities ranging from forex reserves, which were not considered adequate, to very high and volatile inflation inflation and, of course, the twin deficits. But at least two of those three problems are in the process of being tackled. We've got inflation, which is supposed to stay within a good band. We've got forex reserves of more than 450 billion. And, of course, deficits, well, we're still work in progress on bringing down our twin deficits in a structural manner. That wasn't the only bout of uncertainty. We had 2018, a year in which you had outflows of nearly 80,000 crore, both from equities and debt. That pushed the rupee to what is now its record low at about 74.46. But, you know, in 2019, we had a good year. We got 1.35 lakh crore in inflows. So it reminded us that just as money can flow out, it can flow in, and that markets are fickle. What are we looking forward to in the 2020s? Well, I'll tell you a couple of things that you want to keep in mind. One, if you do have low and stable inflation, does that mean that the pace of depreciation on the rupee should come off? Two, if you do open up your debt markets to more foreign flows, could you see a lot more inflows, but could you see a lot more volatility? And three, does India retain its position as pick of the pack among the emerging markets, or are the growth issues that we're facing right now going to derail that? For the answer, well, tune back around in 2030.
Okay, and a story around this on our website, BloombergQuint.com as well. Well, 2019 was the year when some of the most prominent promoters in the country lost control over the companies. Most were forced to sell their family silver and diamonds as lenders invoked pledges. 2020 doesn't look too different. Data on the Bombay Stock Exchange shows that controlling shareholders of at least 50 listed firms have pledged almost their entire stake in the company. Sajid has data for us. Hard data. Sajid, good morning.
Good morning. In 2019, we saw a lot of pledged data getting sold by the lenders because many of the promoters had raised money through their private entities, and this money was used for expansion of the group. Not for the listed company, but for the promoter group expansion into various, various areas. It could be infrastructure, it could be any other new ventures which they entered into, and what they used as capital or collateral was the shares of the blue chip companies which were trading and which were operationally very good in that sense. But what happened after the IL&FS is that many of this funding got dried up because many of the promoters were raising money through NCDs and CPs, and as NCDs and CPs dried up, the refinancing of that took a toll, and promoters were not able to do refinancing through bank or any other mode. And as a result of that, we saw a lot of promoters facing liquidity crunch in terms of refinancing and leading to eventually sales of their shares. We saw some of the big groups getting stuck in this. SL Group was one of them, where Subhash Chandra had to sell down his almost entire stake in Z Entertainment, which is a flagship company. You had Anil Ambani who had to sell out his asset management company, which was the most profitable within Reliance Capital. And then you have Rana Kapoor, who had more than 10% stake, and then eventually had to sell down the entire stake because his promoter companies had debt and that needs to be repaid. So aside of that, you had many other smaller companies, as Imami was one, where we have seen promoters selling down some part of the stake but not exiting completely, or for that matter Bajaj Consumer Care, where Kushagra Bajaj had to sell down around 10% stake to bring down his debt. So what we saw that nearly 53,000 crores as per the Prime database was the amount of shares that was sold in the market in 2019 as part of this deleverage process or share sale that happened in the market. In 2020, as we enter, we see somewhere around 745 odd companies which have a total shares pledged worth of 2.21 lakh as per the Bombay Stock Exchange. Of this, if you try to filter it out, you will see that the A group and B group shares alone are somewhere around 179 companies, and total value of that is around 1.43 lakhs. You filter it down further to see, okay, what are the top 50 looking like. You'll find that 93% of that value is held by the top 50 companies. So 1.34 lakh crores of worth of shares are pledged by the top 50 companies in the A and B group shares, and those are pledged. When I say pledged, it means that more than 35% of the promoter holding is been pledged. It can go up to 100%, from 35 to 100. but it's more than 35%, and that's what many of the investment bankers are saying that what we saw in 2019 is going to happen here, because now promoters are open to the fact that they have to sell the stake in the market. Earlier they would take debt over debt, because as Nilesh has once said, debt is the quasi equity. It's not there. It means you have to take equity, you have to sell equity. So that's what is happening now. We saw, if you look at the top 5 or 10 companies, you have a couple of companies where not promoters have taken that not because of private expansion, but because lenders have sought comfort of promoter shares as part of the capex plan of the existing companies. So something like an Adani Ports, we have seen where nearly 19,000 crores of shares are pledged, or for that matter, Adani Transmission. These are some of the companies which are expanding and doing acquisitions, or for that matter, have projects in lineup, and so the promoter shares are pledged. But others are there where a lot of pledge is being used to do a lot of group activities, which is JSW Steel. We have seen now Sergeant Jindal bringing down his pledge over the last couple of months there, or for that matter JSPL or Torrent or any other or other companies which are there. So what bankers are saying that in 2020 you're going to see furthermore promoters willing to sell it on the market, because they don't want the shares to be undervalued, or for that matter depressed, because the moment you have a higher pledge, your valuation gets depressed, and as a result of which you're not able to, you may end up selling at a lower price. So it's better to sell a chunk of your holding, reduce your leverage, so that the valuation of your blue chip company doesn't come down. At the same time, you retain control of the companies.
Well, interesting. Sajid, thanks so much for putting that into perspective, and some very, fairly high numbers, frankly. If you thought that some of the pain is out of the system, clearly it's not. And again, the story on our website as well, BloombergQuint.com. Do log in and try and read more about this. Okay, let's get stock specific now. Infosys kicks off the third quarter earnings season for nifty companies. The tech giant will come out with its numbers tomorrow. And while there aren't any fireworks expected from the tech companies this time, it's not expected to be too bad either. Agam Bakali is hanging by with what to expect from the top 5 IT companies in the third quarter. Morning, Agam. More of the same, or could there be a surprise?
Good morning. Well, more of the same, I suppose. We have to remember this is the smallest quarter for the entire IT industry. So let's start by taking a look at what the expectations are on a cumulative basis. And if you consider the top 5 companies with the highest market capitalization in Indian IT, well, we're expecting a revenue growth of around 2.5% on a sequential basis, EBIT to grow around 3.2%, profits likely grow around 1.1%. Let's move on and talk about factors that will actually play out in favor and against your IT firms. So when it comes to your overall trends, there are fewer working days because there's a higher number of furloughs on account of the holiday season. Of course, so we have seen strong deal wins over the previous few quarters, and that is, of course, likely to play out very well in favor of the companies. And we're also expecting some very strong contract value, total contract value for a lot of these companies for this particular quarter. At least Axis Capital is of the opinion that the key verticals have bottomed out, and there could only be strength from here onwards. And we also have, however, some slackness when it comes to the banking and financial vertical space. That continues to be under a tad bit of pressure when it comes to America and Europe. But, moving on, let's also take a look at what we're expecting with respect to revenues then, because as you can see, we're expecting a little bit of an outperformance when it comes to Tech Mahindra on account of the AT&T deal they've signed, as well as some expectations of a pickup from the telecommunications space. HCL Technologies is the other one which is expected to do well. We're expecting a relatively stable quarter for TCS and Infosys, nothing out of the ordinary. Moving on to your operating margins, well, among factors that may affect your margins is high subcontractor costs as well as high employee costs. That is something that we have been taking into cognizance over the past few quarters. Of course, given the fact that these companies have seen a lot of large deals come into play, they're going to have to invest a little more in building technologies and indirectly also hiring more people, hiring more talent. Don't forget, there is currently a talent crunch, which is why they're going to have to shell out even more because of the supply issue. Digital businesses, of course, is the one which does contribute to higher margins, and that pie will continue to increase, which is why there could be a counter as far as the fall in margins is concerned. The other factor that may play out in favor of margins is, of course, is a little bit of depreciation of the Indian rupee that we have seen against the US dollar. So that should bring us how we're expecting your margins to move. We're expecting contraction for HCL Technologies and Wipro. On the other hand, an expansion in operating margins on a sequential basis for TCS and Infosys, along with, of course, Tech Mahindra. Well, these are some of the factors, but what else are we keeping an eye on? There is a slowdown in Europe. We are going to keep an eye on how these companies are managing. There's the slowdown in Europe and what their assessment is. Of course, we also would like to know about the early trends that whatever the companies can throw. Those trends will not be visible until February, March, but well, around this time, we do have some managements which start indicating what their conversations are with clients in terms of discretionary spending for the upcoming year. Of course, the outlook on the US capital markets is extremely important because a lot of exposure for a lot of these companies is in the US financial sector. In terms of other factors that we are watching out for, well, of course, the 5G rollout. Tech Mahindra, in this case specifically, will be the company to watch out for. Deal wins and pipeline, naturally, and though we are expecting a very strong one, and integration and acquisition plans, of course, along with the capital and how the free cash flows will be employed if they do not go towards acquisitions. So these are some of the important factors we're watching out for, but it'll be a steady quarter. And again, it's the smallest quarter because of furloughs, and but we're watching out for some of these aspects that I just spoke about.
Thanks, Agam. Thanks so much for putting that into perspective. And as we said, Infosys starts the IT earnings tomorrow, so do watch out for that as well. The last piece on First for today is about two-wheeler and a couple of those. Bajaj Auto stock price had beaten Hero MotoCorp in 2019 and is now extending its lead over its peer. The Tongnes two-wheeler maker has just gotten back to scooters, albeit in an electric avatar. So what's aiding Bajaj Auto? Darshan is here with an analysis. Darshan, good morning.
Good morning. And we've taken the two large ones. Obviously, there are four listed companies in the two-wheeler space, but the two large ones are Bajaj Auto as well as Hero MotoCorp. And you can see after being pretty much on similar trends, Bajaj Auto has actually outperformed in terms of what it's done compared to Hero MotoCorp. So there is a big difference that's happened as far as prices is concerned. Even if you take the auto index, Bajaj Auto has given positive returns over the past 12 months, while Hero has given a negative return. So some of the factors, what's happening. Now, take a look at the growth rates that have come in. So Bajaj Auto, no doubt, if you're looking at it, has actually the growth rate is still better than Hero MotoCorp, even though they had a negative growth of 3% in the December quarter. Hero fared much worse. So Hero continuously is having double-digit declines, that is there, while Bajaj Auto, even though having declined, has been pretty much in the single digit, while at the start of the year, they were managing to grow significantly. So the lower base also aided Bajaj Auto this time around. So that is doing well. Now, take a look at this is the difference between the number of bikes that Hero MotoCorp sold and Bajaj Auto sold, and that has come off significantly. It was always and sometimes in the range of almost over 2 lakh units. Now for the first time in December quarter, it's come below the 1 lakh. So the difference between the bikes that Hero sold and Bajaj sold was close to 90,000 units. So that is the trend that we're seeing. So there is definitely improvement that's happening on the sales. Now take a look at the financials. While Bajaj Auto, the margins which were in excess of 20%, they came down significantly because the management said that they will take a hit on the margins to gain market share, and that is what they're doing. Nevertheless, still over the past few quarters, they have managed to improve their margins to 17%, while Hero MotoCorp hasn't done well from margins of 17%. They still have a little bit of inferior margin given the product mix that they own at this point of time. So that's the margin picture for you. Even if you look at the revenue growth that is there, But Bajaj has actually consistently done well than Hero MotoCorp as far as the revenue growth is concerned. So the trend certainly seems to be on side of Bajaj Auto. And finally, if you're looking at the profit side, while Hero had a good quarter in the first quarter, overall, if you look at the trend, what's happened for the past so many quarters, it's Bajaj Auto. While the trend was pretty much similar over the FY18, the trend certainly seems to be shifting Bajaj Auto's way as far as the profit growth is concerned. A couple of other things at this point of time, it seems that that the analyst community somehow are much more inclined on Hero MotoCorp, but the potential return still because of the underperformance is higher for Hero MotoCorp. So the potential return is 18%. For Bajaj Auto at this point of time, it's just 4%. So the number of sell calls on Hero Moto. Valuation wise, no doubt Bajaj is slightly expensive than Hero MotoCorp, 14 times on an FY20 versus 18 times for Bajaj Auto. But certainly I think the market seems to be looking at growth at this point of time rather than valuations, and that's why Bajaj seems to be outperforming Hero at this point.
Well, it's been an interesting 2019. Let's see if 2020 is different. Bajaj has indeed taken the pole position. Darshan, thanks so much for that piece of analysis. That's all that we have on First Word today, though, but so much more lined up on Indian Open. We discuss markets and macros with Nirav Sheth of SBI Cap Securities and about a possible real estate revival with Pirosha Godrej of Godrej Properties. But after this break, a full tilt towards the day's trade.